Is dividend investing really the best way to retire without having to constantly stress about whether your portfolio will last through retirement? Or is it an overrated strategy? Well, many people dream of living off of dividends, but the reality is that not all dividend stocks are safe, sustainable, or inflation proof. If you don't structure your portfolio correctly, your dividends could be cut and your retirement plans could collapse with that. But here's the good news. By following the 3 essential buckets of dividend investing that I'm going to discuss in this video, you can build a $1 million dividend portfolio that generates stable, growing passive income for decades. So in this video, I'm going to cover 1, why dividends reduce sequence of returns risk and help you sleep at night. 2, how to construct a bulletproof $1 million dividend portfolio. 3, the 3 dividend investing buckets you must include in your portfolio. And 4th, my top picks for sustainable high yield stocks that will last through retirement. So if you're serious about achieving financial independence with dividend investing, watch this video until the end. And if you appreciate deep dive analysis, make sure to smash that like button and subscribe so you never miss my latest dividend investing insights. Thank you very much. So why are dividends the best retirement strategy? Well, dividend investing has 2 massive advantages over alternative approaches like investing in a diversified ETF and just selling your shares gradually over time to fund living expenses. First of all, dividends reduce sequence of returns risk. If you rely on selling shares to fund your retirement, you're at the mercy of Mr. Market. And if the market crashes right after you retire, well, then you'll be forced to sell at a low price, potentially running out of money faster than expected. But with dividend investing, your income stream stays stable over time, even during bear markets. So whether the market is up or down, going sideways, you keep getting cash flow, allowing you to ignore volatility and stay invested for the long term. The second big advantage is that dividends provide a psychological advantage for the investor. If you rely on selling shares for income, you're emotionally tied to stock price fluctuations. Your standard of living literally rises and falls with the market's volatility. And given how volatile the market can be, especially with some of the epic crashes that it can go through where daily falls of 5% or more, and you can see your net worth evaporate by 20-30% in a matter of a month or two, as we saw just a few years ago during the COVID crash. That can cause you to panic during those crashes and ultimately sell because you just think the market's dropping every day and it's going to keep dropping. But if you do that, you're locking in losses and you're selling at the worst possible time. However, in contrast, if you live off of dividend income, you can really pretty much ignore that noise and just sit back, relax, and let the dividend income flow because your dividends are much less volatile than the market. And as long as the underlying quality of your companies are sound and they're covering their dividends sufficiently, they have solid balance sheets, your dividends are going to keep flowing regardless of what the market is doing. And so that's why dividend investing is one of the best retirement strategies, because if you can structure your portfolio correctly, you can just sit back and relax and let that dividend income come in. And not only will it come in, but it will keep up with inflation over time. So with that in mind, let's break down the 3 essential buckets that you need to build this monster, reliable $1 million dividend portfolio. So what are these 3 buckets? Well, bucket number 1 is the income component. You want to fill that up with high yield stocks and ETFs. Bucket number 2, the growth component. You want to fill that up with dividend growth stocks and dividend growth ETFs. And bucket number 3 is the hedging component. You want that to be defensive assets, inflation protection focused. So let's go over each of these in detail and talk about some specific stocks and funds you can put in your portfolio to fill out these buckets. So bucket number 1 is the income component. This is, again, high yield dividend stocks and ETFs. And this is the most important of these buckets because it will generate the majority of your passive income to fund retirement, which is the whole point of this exercise and the whole point of this strategy. So these, again, are high yield stocks and ETFs that pay above average dividends. Think 4, 5, ideally even higher than that, potentially up to 12% if you can be prudent enough at that elevated level. And again, you need to emphasize that these dividends must be sustainable. You're not investing in deal traps. You're not chasing some high yield and praying for a miracle that it will be sustained. You want it to be very sustainable and you can sleep well at night knowing that dividend check is going to come in. And so that means these companies need to have strong balance sheets, strong, durable, and defensive business models, well-covered payouts. And so again, avoid reaching for those high yields and avoiding those ticking time bombs such as mortgage REITs and struggling companies that are heavily leveraged. Those are the ones you want to steer clear of. So instead, what are the kind of companies you want to target? Covered call ETFs are not a bad option, like the JP Morgan NASDAQ Equity Premium Income ETF, or JPQ, or the JP Morgan Equity Premium Income ETF, the JEPI, or maybe even one of the NEOS funds like the NASDAQ 100 or the S&P 500 High Income ETFs, the QQQI and SPYI. Those all offer high single-digit to low double-digit yields, monthly distributions backed with underlying portfolios of blue-chip stocks. You can also go with midstream energy stocks and ETFs. That's a great sector to find high yields. You know, the Alerian MLP ETF, for example, yields over 7%. Or you can look at stocks like Enterprise Products Partners or TC Energy that yield 5.5%, 6.5%, at times 7%. Also grow their payouts over time that beat inflation. You can look at infrastructure and alternative asset managers, stocks like Brookfield Infrastructure Partners, Brookfield Renewable Partners, Blackstone, Brookfield Asset Management, Blue Owl Capital. Those will all get you that 4 to 7% yield, again, depending on when you buy, alongside strong growth over time. Of course, real estate is a great place to invest for passive income. Many people invest in rental properties or other forms of commercial real estate or multifamily assets to get passive income. Well, you can do that with publicly traded stocks too, through REITs, real estate investment trusts, stocks like Realty Income, WP Carey, NNN REIT, Simon Property Group, Mid-America Apartment Communities, and I could go on. These all offer attractive dividend yields. They grow their dividends over time. They have blue chip balance sheets, well-diversified portfolios of high-quality real estate. Not a bad source of passive income as part of a diversified portfolio. Then, of course, you have business development companies. These are investors. They're kind of like mutual funds or ETFs filled with, or closed-end funds really, of a diversified basket of typically hundreds of loans to various middle market companies. They're generally senior secured, so they're somewhat conservative in the capital stack. And you have blue chip managers that do a good job putting these portfolios together, managing them, working out, doing active management in the portfolio to optimize returns. Companies like Aris Capital Corporation, Main Street Capital, Blackstone Secured Lending, those all have excellent track records. And these stocks typically pay out high single digit to low double digit yields, so they can be a great source of passive income over time. So as we talked about here, this income bucket really can ensure your portfolio generates enough passive income to cover your living expenses in retirement without needing to sell any shares. And that's really the beauty of this method. So this is a bucket that's really important that you do your work on. Of course, bucket number 2 helps as well. And that's because this bucket is supposed to ensure that your dividend income keeps growing over time at a rate that will keep pace with or ideally outpace inflation, and thereby maintain or even increase your purchasing power and your quality of life over time. So again, with these, you're probably going to have to settle for a bit lower yields, maybe in the 2, 3, 4, 5% range, but they grow their dividends fast, and they can help you compound your portfolio income over time and create a more dynamic dividend snowball. So for example, you may want to look at dividend growth ETFs like the Schwab US Dividend Equity ETF, the Vanguard High Dividend Yield ETF, or maybe the iShares Core Dividend Growth ETF. These all have reasonable dividend yields, but grow their dividends consistently year after year at a high rate. You can also individual growth stocks like Johnson & Johnson, Procter & Gamble, Coca-Cola. These don't have huge yields, 2 to 3% range, but they are very consistent dividend growers at rates that easily beat inflation. You can also invest in some faster growers like Blue Owl Capital and Brookfield Asset Management. They yield in the 3 to 4.5% range, and they grow their dividends right now at a mid to high single digits annualized rate. That's a great place to find high growth along with a reasonable yield. And again, this is important because if you don't do your work here, your portfolio income is going to lag behind inflation. You're actually going to lose purchasing power over time. And finally, bucket number 3, the hedging component, which is, again, defensive assets for inflation protection and hedging against, major macroeconomic or geopolitical events. And again, you should view this as your safety net. It protects your portfolio from market crashes and provides extra liquidity in emergencies where maybe some of your dividends get cut and you don't want to have to sell shares still. So for this part of your portfolio, you want to look at defensive bonds, cash equivalents, giving you liquidity, as well as perhaps gold and other alternative assets that can hedge against market crashes and inflation. So some ideas here, you can invest in some defensive bond ETFs like the Vanguard Total Bond Market ETF, iShares 0 to 3 month Treasury Bond ETF. These can give you, low risk bond alternatives, cash alternatives. You can also invest in some gold and alternate investments like, for example, the iShares Gold Trust ETF or the SPDR Gold Shares ETF, and maybe sell some options against that one. IAUM, which is the iShares Gold Trust ETF, that gives you really low expense ratio, good buy and hold gold investment. Whereas the SPDR Gold Shares ETF, ticker symbol GLD, gives you that more liquid exposure and really good options exposure. And so you can sell options against your underlying gold position, generate some cash flow that way. So, again, I think that portion of your portfolio is underrated. Many skip over it, but in these uncertain times, if we were to face a major geopolitical conflict, like if the war in Europe expanded and involved NATO and maybe nuclear weapons, or if China attacked Taiwan, or we had some major global financial crisis, this part of your portfolio will suddenly become very valuable. So there you have it. These are the 3 essential buckets to building a well-structured dividend portfolio to generate passive income in retirement. Again, how much you put in each bucket depends a lot on your risk tolerance, how large your portfolio is, what your income needs are. But generally speaking, the first bucket, the high income, that's going to be your largest. The second largest will be bucket number 2, which is the growth, and the third will be your smallest, the hedge. Now again, ideally you can blend 2 or more of these together in some individual securities. I think can meet both requirements, or even all 3 potentially, really well. And the more you can do that, the better. But ultimately, you're not going to be able to do that with all your investments. So these are important buckets to keep in mind and assess them as you build out your portfolio. So what's your ideal retirement portfolio? What does it look like for you? Would you rather invest in ETFs like SCHD, or do you prefer hand-picking individual stocks? So let me know in the comments below what your answer to that question is. And again, if you found this video helpful, please smash that like button, subscribe to my channel for more content. Thank you very much. See you next time.